Today is also the day where we hear from Theresa May. So she's due to give a speech. We have found parts of the speech, and it's a nice Bloomberg scoop saying that, look, she wants the UK probably to leave the single market and to renegotiate from scratch. This will be a huge headache for banks.
Well, I think we wait for the details because I think the devil is in the details on this one. But I think it's been pretty clear from the start that it's very hard to renegotiate the stance of the UK with the European Union. Being a Swiss bank and living in Switzerland, we've seen that over many, many years, that if you're outside the EU, it's very hard to, every single sort of right or to issue bonds, to enter into the market, needs to be negotiated. And sometimes these are long and winding negotiations. Just to give you an example, MiFID and EMIR, the European market rules, had to be taken into Swiss national law before we were actually compliant and comparable with European regulations. And so this is a hard thing to achieve. My view has always been Britain has to start somewhere new. And I think there are two things Britain needs to do. I think it's pretty clear that the European relationship will be kind of status quo minus. Won't be as good as it was. I think they can negotiate many things, but it's very important for Britain to step aside and also renegotiate with the rest of the world their relationships on trade and financial services. And I think since the Europeans are in an election campaign almost till the end of the year, it's probably good for Britain to do it parallel, but to focus at the start till the end of the year on the foreign relations.
But actually, so if there's all these these elections that you're talking about, so the timeline of negotiations will probably be a lot longer than we think at the moment.
Absolutely.
So if you're a chairman of a bank, what do? Do you try and speak to your employees to try and move people to Europe now? Because if you're out of the single market, then again, the timeline is different if you operate in business or if it's the government negotiating.
No, so I think what is important for banks is optionality. Banks need to create optionality that in case we do not have market access from the UK to the European markets, which is my working assumption, and being Swiss, we don't have it in the same fashion as European banks have it from their home market, we need to establish some bridgehead, so to say, in the European Union, and we've done that. We've created a European entity in wealth management in Frankfurt, and so we do have optionality to move people around onshore into the EU from the UK, but I think there's...
But how many people are you thinking of moving?
Well, look, virtually there's no sense in talking about that now because it all depends on the final agreement. So it really depends. And since the City of London is a big feature of the UK economy, I think we will get some traction between the negotiations on financial services. So for us, it's important to create optionality now, but then let's wait and see what the final agreement brings. If you move people, that can be done pretty quickly. So as long as we have market access, so at least for the next 2 years, I think the pressure is not that high. The pressure is there to create the optionality, but not really to start action now.
If we look at the banking landscape, because of Brexit, are there clear winners and losers? And does it depend again on whether you're a UK bank, a Swiss bank, or a French bank?
Well, look, like with all these things, I know that it's not good to start from discussing an interim regime, but I think there will be a transition regime. New regulation is usually phased in over many years, and I can imagine that part of the feature of the negotiations is let's agree on what the new steady-state relationship is, and then let's agree over what speed we're going to get there. Because the sheer process of putting European regulation and European laws into British laws and then changing them to basically match the features of the UK economy is going to be a long time.
At a time when also the US is probably deregulating, do you expect light touch regulation in the US regarding banks? And again, what does that mean for the European banks? Are you on a completely different playing field?
No, my expectation is we'll see less additional regulation and less intrusive regulation come out in the US in particular. I don't think there will be, except some parts of Dodd-Frank and others, there will be a big rollback of regulation. Most of what happened in the financial crisis basically showed that banks need better capital, better liquidity planning, more resolvability, and the banks have put all of that in place, and I think now we wouldn't actually want to go back on some of the things we've changed. But I think medium to long term, what we're concerned is we've got already a lot of capital and liquidity that is really bolstered. Now, further capital is not the answer to every problem in banking. And I think we're using the single tool, namely more capital, a bit too intensively. It's a bit like monetary policy. Monetary policy, in my view, also has run its course, and the US government is likely to put in more fiscal and more structural policy so that monetary policy can rebalance. And we hope for the kind of rebalancing also on the regulatory side, that we're going to get less additional regulation and more a settling of that regulatory framework.
And Axel, we'll come back to, of course, your time at the Bundesbank and and we'll talk about central banks shortly after a small break. But actually, when you come to the banking side, so if it's not raising capital, what is it? Are you looking at, for example, cost sharing with other banks, the back office?
At the moment, really, since you cannot grow your front business and since interest rates are at zero, you can't really influence revenues very much. So it's all about cost. And banks are consolidating, banks are optimizing, banks are actually looking at joint ventures in many areas, be it, working together on certain clients, providing certain products globally.
But is that with your biggest competitors?
No, I think you look in terms of cost synergies, you can look at that because market infrastructure in a market like Switzerland or in the European market is a shared infrastructure. If you look at central counterparties, if you look at the deep liquidity pools that we have in London, these are joint ventures by all the banks where there is a central counterparty that does all the clearing and settlement between banks. Yes, so if cost of trading is cost of holding liquidity is high, banks working together can actually bring that down.
What about consolidation? If you, first of all, do you assume that Europe is overbanked? And what's the solution?
Well, I think we'd love to consolidate the market. We would be, because we've done our homework and we have a strong capital position, we would be one of the banks that could actually be active in that. But when you talk about too big to fail, many regulators tell you, you're too big, full stop. Yeah. And so the fact that the major banks already sizably have reduced their balance sheet a lot, I don't really see a switch that is put in the other direction where banks are given a whole go-ahead to consolidate the market. We will grow organically and we will do acquisitions, targeted, but I don't think...
Where?
Well, I think basically our core focus is wealth management.
Okay.
And so wealth and asset management, asset gathering business, we're becoming more global and we're looking for growth in Asia, we're looking for growth in the Americas. In Europe, consolidation will basically mean that we're kind of restructuring our business onshore.